slideshow. If I custom the slideshow, all right. So just a few points on foreign exchange then, guys. An FX trade, well, I don't need to go through the, let me just transition my screen 1 second. So an FX trade, with you guys, I don't need to go through what an FX trade is. You've been doing them every day. Just some facts about the market. Just in terms of size, $5.3 trillion trades on the FX market each day. If you have a look at it compared to its nearest competitors, it is by far the most massive market. New York Stock Exchange, all equities, all futures, and there you see the FX market. Currency pairs traded, as you'd expect, Euro, JPY, Pound, Aussie dollar, really forming the majority of market activity. Market participants, investment banks, brokers, customers, clients, and obviously proprietary traders such as ourselves. But let me get on to the fix so you guys understand what Jason was saying about the 4 p.m. fix. Just go through these just to make it as relevant. Okay, so the London fix. So what is the purpose of the fix? This is at 4 p.m, 60 seconds from 3:59:30 to 4:00:30. There's a 60-second window whereby the majority of FX trades take place. And the majority of FX trades take place here in London, just outside Canary Wharf. Over 70% of all foreign exchange transactions in the world take place there. And the reason why the FX fix exists is because, well, imagine if you were, let's say, I don't know, the Sovereign Wealth Fund of Norway, and you wanted to divest a $4 billion US dollar investment and convert those dollars into Norwegian kroner, for example. Or let's say, actually, you wanted to convert those dollars into euros for another investment. You know, you're an asset manager, you run a sovereign wealth fund. You don't want to punt around on the FX markets because remember, you know, every 1 minute that this FX market changes valuation, you could be making or losing your fund a lot of money. So you don't want to take on that risk. So rather than take on the risk of doing that FX trade at 11:01 or 11:15 or 11:25, which can make a huge difference, you know, you say to your broker, give me the 4 p.m. fix. And by saying, give me the 4 p.m. fix, you're saying, what I want is the average price over the 60-second window from 3:59:30 to 4:00:30. Just give me that average price. Now that all sounds fine. So it's a benchmark. It encourages asset managers to trade at the fix. Takes risk away from the timing of the FX trade, and in that way makes sense. Okay, introduced in 1994. So here we go, 3:59:30 to 4:00:30. There's that 60-second gap. And if I am let's say, if I'm the investment bank and I know you're getting the average of the 4 p.m. fix, then I have to try and, if you like, as closely as possible, match your trade, don't I? As it's getting to 4 p.m, let's say if the average price of that 60-second period is the euro dollar trading, I don't know, let's say for using today, the average average is the euro dollar trading at 1.05370, then as we get to that 1 minute window, I've got to try and get that trade on at that price as closely as possible. And then I can hand that trade to the client. That's what he's paid me for. Now, what's interesting with the London fix, however, is if I know, for example, let's say I've got the Norwegian Sovereign Wealth Fund that's going to be buying 4 billion euros instead of US dollars at 4 p.m. Let's say I'm a trader at Goldman Sachs. If I decided to share that information that the Norwegian Sovereign Wealth Fund will be putting this large purchase in, and I share it with my friend that works at Morgan Stanley, then my friend at Morgan Stanley goes, that's interesting. So I know on the few seconds leading up to the London fix, there's going to be a big buy order going through. And therefore, with that information, if I start to get long just before the fix, then I can push the price higher. All of my colleagues can push the price higher. We can all push the price higher. Net, the Norwegian Sovereign Wealth Fund gets a terrible deal, but we'll make a bit of money on the way. Okay, so this is guaranteeing the fix, which has been abused and recently resulted in significant fines. I'm not going to mention any particular names, but it's all about front running. It's all about front running and collusion. So it's a legal practice of market makers to take advantage in advance of knowledge of pending orders from its customers. And that's exactly the situation that I've just given. Take advantage of pending orders from its customers. Now, I just want to touch on this. As you can see, this is our firm's Fintrotech slides. We're talking about banging the close, pushing that price higher. And that's exactly what you could argue has just happened in cable here, banging that close. If we do get time, guys, later on, either this week or next week, it would be great to do this lecture in full and even do the simulation where you can bang the close here. That would be fantastic. Okay, I thought I'd help just tell you what we mean by the London fix. It's that 4 p.m. 60-second window whereby currency traders here, specifically in London, might collude to try and take advantage of pending client orders, knowing that those client orders have to be filled in that 60-second window. Hope you found that interesting. Thanks very much.